It's 1816, and the British government is burning its own paperwork. Parliament has just abolished income tax, and to prove it's gone forever, they order the records destroyed. Not archived, burned. It didn't work, by the way. Duplicate copies were sitting in the King's Remembrancer's office, and the tax came back. You almost certainly paid it this month. But what's important is that income tax was never meant to be permanent. It was an emergency measure brought in for one very specific reason that we'll get to, and everybody involved assumed it would go away again. And as prominent people start floating the idea of scrapping income tax, it's worth asking, how did we get here in the first place? This is the story of the rise of income tax. From an emergency measure to a tax on the rich to money disappearing from your paycheck before you ever see it. By the end, you'll understand why it kept coming back, how governments made it almost invisible, and why salaried workers became the easiest people in the economy to tax. You'll also discover why one of the most successful tax salesmen in history was this Donald.
Liberty, this is our fighting song.
Income tax is younger than you think. Younger than the car, if you count this steam-powered vehicle. Younger than the United States, and younger than the phrase everybody uses to argue that it's inevitable. You've heard it before. The only things certain in life are death and taxes. But that line is 80 years older than income tax. A playwright called Christopher Bullock wrote a version of it in 1716, and Benjamin Franklin made it famous in a letter in 1789. But neither of those men ever paid a penny of tax on their wages, because no such tax existed anywhere on Earth. They were talking about the taxes a government could actually see: land, salt, windows, and tea. The man who changed that was William Pitt the Younger.
I shall be brief, as I have rather unfortunately become Prime Minister right in the middle of my exams.
Pitt became the UK's Prime Minister at 24, and he is still the youngest the country ever had. But it wasn't until he was 39, in 1799, that he invented income tax. And he did so for one reason. He needed to fund a war. Britain was fighting France, and the bill was growing faster than anyone had planned for. It wasn't an idea for how a modern state should fund itself, it was an emergency. And because it was an emergency, it kept getting cancelled. It was abolished in 1802 during a truce with France, brought back in 1803 when the fighting resumed, and repealed again in 1816 once Napoleon was finally beaten. Remember the bonfire? For the next 26 years, Britain had no income tax at all. The deal was simple: no war, no income tax. Then, in 1841, Sir Robert Peel became Prime Minister and found a hole in the nation's finances. And there was a moral argument for it too. A tax on tea or bread takes the same amount from the rich and the poor. Income tax could rise with a person's ability to pay. To its supporters, that did not merely make it lucrative, it made it fairer. So, in his 1842 budget, he brought income tax back at roughly 3% on incomes above £150 a year. Around one person in 50 paid it, and everyone else got cheaper food, because he cut duties on hundreds of imported goods to pay for it. He promised it would be temporary, 3 years to get the books straight. But, as we'll see, it hung on, even though successive governments often wrestled with it philosophically and promised to remove it. Listen to William Gladstone speaking in 1853 when he was Chancellor of the Exchequer. The machinery of the income tax, involving the objectionable principle of self-assessment, in my opinion, can never be satisfactory to the country because of the tendency to immorality, which is, I fear, essentially inherent in the nature of the operation. His problem was not simply that people disliked paying it. Income tax asked people to declare how much they earned, and Gladstone thought that created a reward for dishonesty. Honest people disclosed everything. Dishonest people concealed it. The better liar could end up paying less. In his words, self-assessment led to grievous frauds upon the revenue and made the tax more unequal than it appeared. It did not just collect money, he argued, it tempted an entire country to cheat. Gladstone still renewed the tax, but his objection exposed the problem that would define the next century. How do you turn income tax from something a small number of wealthy people declare themselves into something governments can reliably collect from almost everyone? The answer would arrive during another war. Around this same time, across the Atlantic, the same pattern was playing out, just much faster. Congress enacted an income tax in 1861 to help pay for the Civil War. 3% on incomes above $800. Once the war debts were under control, it was allowed to lapse in 1872. But by the 1890s, American industrial fortunes were enormous, and the federal government was still funding itself mainly through tariffs, which fall hardest on ordinary people buying ordinary things. So Congress tried again, with a small peacetime tax on the wealthy. But in 1895, the Supreme Court struck it down. The only route left was to amend the Constitution, and that took another 18 years. The 16th Amendment was ratified in 1913, the year after the Titanic sank. So America existed for 137 years without a permanent federal income tax, more than half its existence. And when it finally arrived, it wasn't a tax on ordinary workers at all. Thanks to generous exemptions, fewer than 1 in 100 Americans paid it. You needed to be earning above $3,000, which lands somewhere near $100,000 in today's money. Then, as usual, there was a war. When America entered the First World War, the top rate of income tax was 7%. By 1918, it was 77%. Between the wars, it went back to being what it had always been, a tax on the comfortable. In 1939, only around 5% of American workers paid it at all. Then Pearl Harbor happened, and America was dragged into the Second World War. The Revenue Act of 1942 dropped the personal exemption to $624 a year. If you earned more than $12 a week, you were now a taxpayer. Roughly 13 million Americans joined the tax rolls, and by the end of the war, about 3/4 of American workers owed income tax. Tens of millions of people who had never filled in a tax form in their lives now had to do it correctly, on time, and preferably without complaining. So the Treasury went to Hollywood. In 1942, the Secretary of the Treasury, Henry Morgenthau Jr., asked Walt Disney to make a film that would persuade Americans to pay their income tax. Morgenthau wanted a generic everyman, Mr. Average Taxpayer. Disney wanted his biggest star. And so the job of selling income tax to the American public went to a chaotic and easily impressionable cartoon duck. The film was called The New Spirit, and it was turned around in 4 weeks. It opens with Donald listening to the radio, bursting with patriotism, desperate to be told how he can serve his country. Let's watch and listen to the actual clip here.
Are you a patriotic American?
Yes, sir.
Eager to do your part?
Yes, sir.
Then there's something important you can do.
The radio tells him, pay your income tax, promptly.
Your income tax.
Income tax?
Yes.
His enthusiasm dies instantly, and then the radio starts working on him.
Taxes for ships. Taxes for democracy. Taxes to beat the Axis.
By the end, Donald can't wait. He fills in the short form, discovers he earns $2,501 a year and that he owes $13. Then he runs the money to Washington himself. The Treasury put this film into around 12,000 cinemas, free. In March 1942, 22 million Americans filed a return, 7 million of them for the first time in their lives. It was even nominated for an Academy Award for Best Documentary. And Irving Berlin, the man who wrote White Christmas, contributed a song called "I Paid My Income Tax Today." And it worked. By 1945, around 90% of American workers were filing a return. Over 42 million people were paying a tax that 30 years earlier had applied to 1% of the country. But the propaganda only solved half of the problem, because in 1942, you still had to physically hand the money over. Once a year, you had to take a portion of your own money and give it to the state, deliberately, knowing you were doing it. That is a very hard thing to ask of 30 million people every year. So in 1943, the government stopped asking. Congress passed the Current Tax Payment Act. From that moment, your employer was legally required to take the tax out of your wages before the money ever reached you and send it straight to the government. Before 1943, income tax was a bill. You earned your money, you held your money, and once a year you consciously handed a piece of it back. And you felt it. Plenty of self-employed people still do. But after 1943, for most people, income tax became a number on a payslip. Money that simply never arrived. Britain followed 1 year later, and in part, it settled Gladstone's argument as well. He thought income tax was corrupting because it asked people to be honest about their own money. Withholding took the biggest temptation off the table, at least for most people, because from that moment on, your employer declared your wages for you. One of the young economists who helped design that system was Milton Friedman, then working in the Treasury's Tax Research Division. He went on to become the most famous free market economist in the world, and he spent the rest of his life uneasy about what he had built. I played a significant role, no question about it, in introducing withholding. I think it's a great mistake for peacetime, but in 1941 to 43, all of us were concentrating on the war. I have no apologies for it, but I really wish we hadn't found it necessary, and I wish there was some way of abolishing withholding now. Once income tax could be taken automatically, governments discovered just how much money it could raise. By 1944, the top marginal rate of American income tax had reached 94%. That does not mean anyone handed over 94% of everything they earned. It applied only to the top slice of very large incomes. But the rate was real. Britain went even further. By the mid-60s, the highest rate on some investment income reached 95%. Which is how 4 working-class lads from Liverpool, who were bitten by that tax, became some of the most famous tax protesters in history. Taxman, the opening track of Revolver, was written by George Harrison after he discovered how much of his income was going to the British government.
There's one for you, 19 for me.
The Rolling Stones did not write a song about it. They moved to the south of France instead. And this is where governments began learning the limit of taxing very high incomes. Push the rate high enough and wealthy people do not simply stand still and pay it. They hire accountants, create companies, move assets, delay income, change countries. An entire industry appears between the taxpayer and the tax collector. So top rates eventually came down. Reagan and Thatcher made the political case against them. Economists argued about their effect on investment and incentives, and governments increasingly preferred rates they believed people would actually pay over rates the wealthy would devote their lives to avoiding. The top American federal rate today is 37%. Meanwhile, at the bottom, many households have been removed from federal income tax altogether. For 2025, the Tax Policy Center estimated that around 40% of American tax households would owe no federal income tax. That does not mean they pay no tax. They still pay payroll taxes, sales taxes, fuel taxes, property taxes, and plenty of others. They just do not pay this particular one. So the lowest earners are often outside the income tax system. The very richest have options. Which leaves one group that is remarkably easy to find. High earners, not rich yet. Doctors, lawyers, engineers, executives, senior managers. People earning genuinely good money, but whose wealth still arrives mainly through work. Their salary appears at the same time every month. Their employer reports it. The tax is removed before it reaches their bank account. A surgeon earning $300,000 a year is taxed before she receives it. But a millionaire investor? Well, listen to entrepreneur Stephen Bartlett describing it himself.
Someone came to me at 27 and said, Stephen, do you know you can just take a loan against your public stock? And I went, what? They went, you can just get a tax-free loan. So if your stock is worth $50 million right now, they will give you a 50% loan without paying tax on that stock. I couldn't believe this was possible. And so I was like, is this what all the rich people do? And they told me, yes, this is how it works.
Income tax is therefore not always hardest on the people who possess the most wealth. It is often hardest on the people whose wealth arrives in the form governments can see most clearly, because those are exactly the people the system built in 1943 was designed to catch. So is income tax inevitable? Not quite. Several countries still have no personal income tax, including the UAE and Saudi Arabia. Antigua and Barbuda abolished theirs in 2016 and have not brought it back. That does not make these countries tax-free. Governments always need money. They simply collect more of it elsewhere, through consumption taxes, corporate taxes, customs duties, property, tourism, and, in the Gulf, natural resources. China introduced personal income tax in the 1980s, but it still raises a relatively small share of government revenue from it compared with countries such as the United States. The second largest economy on Earth does not depend on taxing wages to anything like the same extent America does. None of this proves that every country could abolish income tax tomorrow. It proves something more basic. Taxing personal income is a political choice, not a law of nature. Every tax system is a choice about which forms of economic activity are easiest, fairest, and least damaging to tax. And the activity our system chose to tax most heavily was human work. And technically, even Britain still treats income tax as temporary. The authority to collect it must be renewed through legislation. Without that renewal, it would lapse. Parliament has remembered every year since 1842. The argument is now returning around the world. President Trump has suggested that tariffs could one day replace income tax.
And as time goes by, I believe the tariffs paid for by foreign countries will, like in the past, substantially replace the modern-day system of income tax, taking a great financial burden off the people that I love.
Which, as we have seen, is not a new idea. Tariffs were how the American federal government funded itself for much of the country's early history. But there is now a much bigger reason to reconsider what we tax. Work itself is changing. For 2 centuries, income tax worked because human labor produced an enormous, visible, and relatively stable stream of money. People went to work. Employers paid them. Governments took a percentage. But what happens if machines begin doing more of that work? A company that employs 1,000 people creates 1,000 taxable salaries. A company that replaces hundreds of them with software may produce the same amount or more, while generating far less taxable labor income. The system does not merely fail to prevent that substitution, it can actively encourage it. A salary is subject to income tax and payroll deductions. The returns from owning the technology may be taxed later, taxed at a lower rate, or not taxed until an asset is sold. This is the point Democrat presidential frontrunner Pete Buttigieg recently made.
Well, our tax system taxes wealth less than it taxes work. That's a problem. That's an even bigger problem now that AI is coming for jobs, because there's basically a thumb on the scale, a subsidy, in effect, from the US government saying, giving you a little more reason to automate a job than you otherwise would.
Income tax began as an emergency measure to fund a war. It survived because governments kept encountering new emergencies. It expanded because world wars pulled ordinary workers into the system. And it became permanent because withholding made it reliable, automatic, and almost invisible. Income tax did not take over simply because governments proved it was the fairest possible tax. It took over because it could be progressive. War made it necessary. Employers made it easy to collect. And salaried workers made it almost impossible to avoid. For more than 200 years, that system has followed the money to the workplace. But the money is beginning to move, away from salaries, towards assets, algorithms, and ownership. So the question is no longer whether income tax was a clever invention in 1799. The question is whether it is still the right invention for the world we are building now. William Pitt reached for income because he needed money fast. 2 centuries later, as machines begin doing more of the work and wealth grows increasingly outside wages, we may need to decide where governments should reach next. If you were the next William Pitt the Younger, what would you do?
Which Pitt would this be? Pitt the toddler? Pitt the embryo? Pitt the glint in the milkman's eye?
Welcome to Tax Tantrums. Subscribe for more.